Welcome, everyone, to our finance crash course. Today, we're going to cover the essential terms you need to know for investing success. Whether you're a beginner or looking to brush up on your financial knowledge, this crash course will equip you with the fundamental concepts that will help you navigate the world of investing. So, let's get started. Asset allocation refers to the strategic distribution of your investments across different asset classes, such as stocks, bonds, and cash. It's an important concept because it helps you balance risk and reward based on your investment goals, time horizon, and risk tolerance. By diversifying your portfolio across various asset classes, you can potentially reduce the impact of market volatility and increase the likelihood of achieving your financial objectives. Diversification is a risk management strategy that involves spreading your investments across different securities, industries, and geographic regions. The goal is to minimize the impact of any single investment's performance on your overall portfolio. By diversifying, you can potentially reduce the risk of significant losses and improve the chances of capturing positive returns. Remember, don't put all your eggs in one basket. Compound interest is a powerful concept that can significantly impact your investment returns over time. It refers to the interest earned on both the initial principal and any accumulated interest. As your investment grows, the interest is reinvested, allowing your money to grow at an accelerated rate. The longer you stay invested and let compound interest work its magic, the greater your potential returns can be. So, start investing early and let time do the heavy lifting for you. Risk-adjusted return is a measure of how much return an investment generates relative to the amount of risk taken. It's essential to consider risk when evaluating investment opportunities. Some investments may have high potential returns but also carry significant risks. Others may have lower returns but come with lower levels of risk. Understanding the risk-return trade-off is crucial for making informed investment decisions that align with your risk tolerance and financial goals. Market capitalization, or market cap, is a measure of a company's size and value in the market. It's calculated by multiplying the company's current stock price by the number of outstanding shares. Market cap is often used to categorize companies into different segments, such as large cap, mid cap, and small cap. Understanding market capitalization can help you evaluate the risk and growth potential of different investment opportunities. In summary, asset allocation, diversification, compound interest, risk-adjusted return, and market capitalization are key terms that every investor should be familiar with. By understanding these concepts, you'll have a solid foundation for making informed investment decisions and increasing your chances of long-term financial success. Thank you for joining our finance crash course. If you found this video helpful, don't forget to subscribe to our channel for more educational content. Feel free to leave any questions or comments below. Remember, the more you know about finance, the better equipped you'll be for investing success. Happy learning! Thanks for watching. Please subscribe to our channel.